Thank you everyone for joining, and thank you especially to Jason Friesen and the Outline Financial team. The reason why they're such valued partners for us is because they always bring stats and figures. And when there's so many headlines going on, you can use that information to make informed decisions. We also value the time they take to understand each individual's personal situation and kind of create the best scenario plan around that. That kind of speaks to what we do as well in real estate. So thank you, Jason, and your whole team for taking time out of your day to give us more information so we can make informed decisions going forward.
Thanks for having me. Looking forward to doing this again. So what I wanted to talk about today, there's always, headlines talking about interest rates. I wanted to help kind of give some understanding to what's going on, what that means when you hear on the news that interest rates are moving or things have stayed flat, what that pertains to, how that potentially impacts the market as well. So I'm going to dive right into it. When you're watching the news and you hear interest rates are changing, the Bank of Canada has made an announcement. That's referring to the Bank of Canada's overnight lending rate, also called their target rate or their policy rate. The overnight lending rate is the interest rate at which major financial institutions borrow and lend one-day overnight funds to and from each other in Canada. The Bank of Canada sets this rate, which is a critical tool to help control inflation, maintain financial stability, and influence broader economic conditions. The Bank of Canada meets 8 times a year, and they announce any changes to its overnight lending rate during those meetings. These changes usually have an equal and immediate impact to banks or lenders' prime rates. Prime rate is also referred to as the prime lending rate. The prime rate is what banks use as the base for their variable rate mortgages, secured lines of credit, and unsecured lines of credit. Variable rate products are priced at a premium or a discount to the prime rate. For example, a HELOC, which is also known as a home equity line of credit, may be at prime plus 0.5%, while a variable rate mortgage might be at prime less 0.5%. Typically, the overnight and the prime rates move together. This gives you a recap of the changes that we've witnessed to the overnight lending rate and therefore the prime rate over 2022 and the start of 2023. What you can see is a total of 425 basis points in increases, 4.25% from March of 2022 to January of 2023. To put that into a historical context, we have not witnessed interest rates increase at that level, at that pace, since going back into the 1990s. When we're just looking back over the last few years, the overnight rate was as low as 0.25 from March of 2020 to March of 2022. So we had a 2-year period where rates didn't change, and then in a year period, witnessed interest rates increase drastically. Again, the fastest rate ascent in over 30 years. We've seen a few times where rates have come down quickly, mainly in 2001 and 2008, all tied to pretty significant financial or economic challenges, global economic challenges. For the most part, you'll find overnight and prime rate will almost always move together. There have been a few exceptions, but before I go to the next slide, again, you can see the changes and how rapid they were. Seeing some pretty significant increases, a 1% increase last year, 75 basis point increase, following that, a couple 50 basis point rate increases. Again, when you put that into perspective, typically we'll see interest rates, when there are changes upward or downward, moving at, maybe 1 to 1.25% over a year at most, if you're looking back over the last 20 years. So what we really witnessed was an extraordinary time from a rate increase perspective. This is not something that normally happens. This was obviously done to try to cool off inflation. Some say that the Bank of Canada was probably a little bit late to the party. The reality is that we probably shouldn't have seen interest rates decrease as much as they did, and then for the bank to take so long to actually start increasing, the Bank of Canada finally start increasing them. So I mentioned that the prime rate and the overnight lending rate typically do move together with a few exceptions. The couple of times that it happened where the Bank of Canada didn't pass on the full discount or increase, January 2009 after the subprime crisis, and in 2015, January and July, they didn't pass on the full quarter point change. They actually did smaller increases. That was likely in part due to the banks having an increase in their cost of funds at those times. But for the most part, barring these few instances where rates have, changed separate from overnight lending rate to prime, you can almost always expect the prime rate and the overnight lending rate to move hand in hand. So the big question is, where are rates forecasted to go? And this is important for clients that are trying to figure out which type of mortgage product they should take, or should they take a variable rate, or should they take a fixed rate? So currently the overnight lending rate is at 4.5%. When you look at this, going out and looking out to the end of Q4 next year, so the end of 2024, you've got a wide, kind of not a super wide, but you've got some banks thinking we'll see a 1% decrease, some thinking a 1.5% decrease. And then if you look at TD, they think that prime rate or the overnight lending rate will be 2% below where it is today. So this helps clients decide, do I look at a variable rate? And if I do, where are things headed? Or do I maybe look at a fixed rate? So again, these, it is, a fluid situation and can change. As the SVB bank collapse showed us, anything can happen. And frankly, the situation prior to the bank collapse in the US was that we were likely going to potentially see another rate hike this year, not likely see the Bank of Canada sit on the sidelines, which is now more widely expected. So you can see how data can really change, the drop of a hat, the forecasting on this. So this is the most recent forecasts that have been released by the bank. Again, you can see where banks are at. This gives you a rough idea of where the big 6 banks in Canada are forecasting rates to move over the next couple of years. So what is a variable rate mortgage? Variable rate mortgages, just to understand, are usually closed products. They float as prime rate moves up or down. So does the interest rate that you're paying, but you're typically locked in with a variable rate mortgage. You would pay a penalty if you broke it off early. The benefit of taking a variable rate tends to be that the penalties usually or the same or less than fixed rate penalties. So some borrowers like the flexibility of having a variable rate. As I mentioned earlier on, variable rate mortgages are typically priced at a prime minus discount. When we look over, the last, 20 years, the rough average discount is about prime less 50. Up until, I'd probably say the early part of 2022, it was common for most borrowers to be able to secure 1% below prime. So prime is at, it's currently today at 6.7. You would be paying 5.7 as your interest rate on that. This discount really depends on lenders' cost of funds when you do get your mortgage. What stays static when you take a variable rate is the discount that you're approved for over your term. So as the overnight and prime rate increase or decrease, what stays static is that discount. So if you're 1% below prime, wherever prime goes up or down, so will your interest rate. So there are 2 types of variable rates, and it's important to really understand the difference between the two. Why this is important is that on the news, you probably have heard trigger rate, clients are hitting their trigger rates on variable rates. So there's 2 types of variable rates. There's a variable adjustable and a variable non-adjustable. So the first one, you would have as your interest rate, or so as the prime rate increases or decreases, the payment would change accordingly and the amortization stays the same. So your payment, again, let's just say you're at prime less 1%, prime is 6.7 today. Your payment would be based off of your remaining amortization and the current rate, which is 5.7. If interest rates drop down from there, your payment will adjust down as well. Conversely, if they go up, your payments will adjust upward. The other option, which is what a lot of clients with some of the big banks opted for, prior to all of the interest rate increases, because a lot of people were unaware that we were going to see interest rates increase at the level they did. Non-adjustable variable rate. So what happens is your payment stays static, but the amortization would increase or decrease based on changes to the overnight lending rate and prime rate. So if your payment is locked in and interest rates go up, what's happening is you're actually increasing your amortization or the total amount of time it takes to pay off the mortgage. So, for these non-adjustable variable rate mortgage holders, as rates increased, more of their payment went towards interest versus principal versus having, a fixed payment or an adjustable, a variable adjustable where payments changed. Some borrowers, their amortization extended until a trigger rate was hit, the point where their entire payment was going towards interest. So there's some cases where the banks haven't made the clients adjust their payments, but the trigger point is that point where the bank actually reaches out and says, hey, you need to adjust your payment to actually cover principal and interest. And why this is important is a lot of people took variable rates in 2020 and 2021 when rates were at historical lows, and then seeing such a massive increase to interest rates over a very short period of time has put a lot of variable rate clients with non-adjustable variable rates in a position where they're either paying their payment completely going towards interest, or maybe not even covering the interest payment and giving themselves a negative amortization. So instead of having the amount of time it takes to pay off their mortgage decrease every month with payments, they're actually adding time every month that their payment goes by. The problem with this is that at renewal, the likely scenario is that banks are going to require these clients to actually bring their payments in line with what the current amortization is. So we had clients who had non-adjustable variable rates, who actually had amortizations that increased all the way to 45 years. So keep in mind, 30 years is the maximum that you can take if you're purchasing or refinancing. So some of these clients have added an additional 15 years on the life of their mortgage. Now, the ways around this would be to increase your payment yourself. I think that would be the most important thing to do, is to either increase your payment to bring yourself in line with what your current amortization should be, or make a lump sum payment. Sadly, most people don't have the option to make a lump sum payment to put towards their mortgage. They're already being squeezed and stretched due to higher costs of living with inflation being so high. It's important to note that, typically banks have a non-adjustable or an adjustable variable rate. They don't offer both. So depending on the lender you're with, you may have one or the other. They don't offer both. The nice thing about working with a mortgage broker is that we have access to both of these products. So, for someone that's keen to make sure that they continue on the same amortization and pay their mortgage down, that adjustable variable rate that changes as rates move is likely the better product. For someone that's concerned about payments increasing, that non-adjustable product maybe makes more sense. It really comes down to individual circumstance. But at the end of the day, it's important to make sure the client has explained all of this so that they're making an informed decision. So when you hear on the news talk about, banks hitting trigger points or trigger rates with their clients, this is what it's in reference to. Clients that are making mortgage payments every month that are not covering the interest on their mortgage, let alone paying down any principal. So this is something that's important to be mindful of, because the adjustment, if someone hits a trigger point and the banks do adjust the payments, it could mean a pretty significant, change to monthly payment. And again, a lot of borrowers are likely in a situation where they're already squeezed from other expenses increasing in their lives. So what's a fixed rate? A fixed rate is, just that. It's a fixed rate for a period of time that you select. They're always closed mortgages. Again, penalties on fixed rates are typically higher than penalties for variable rate mortgages or lines of credit. The most common term is a 5-year fixed rate, but 1, 2, 3, 4, 7, and even 10-year terms are also available. Fixed rate mortgages can often be ported to a new property to avoid penalties or preserve a good contract rate. So this would be the case if someone bought a place in 2020 or 2021, and maybe they locked in a fixed rate at 2.5%, for example. Instead of having to break that mortgage if they were to buy a new house and take it over to another property, they do have the ability to actually bring that mortgage over to a new property and avoid paying any penalties. So they, the benefit is obviously reducing or not paying any penalty, but also taking advantage of the low rate that they have. So again, I mentioned the most common term for fixed rate is a 5-year fixed. But more and more, we're seeing clients right now at this current economic environment opt for shorter term fixed. So that would be a 2 or a 3-year term. 1-year rates are very high right now, so a lot of clients are steering clear of that. But we are, looking at, I'd say, 80 to 95% of our clients, 80 to 90% of our clients right now are opting for 2 or 3-year fixed rates. Again, I think it locks them in for a reasonable amount of time and allows them to have some certainty over the short term, but then allows them to hopefully either take advantage of a lower fixed rate or a lower variable rate down the road when interest rates do hopefully start to come back down. So fixed rate forecasting is important. It's important to understand how fixed rate forecasting is done. To get a sense of where fixed rates are at, 5-year, for example, you can look at the 5-year Canadian bond yield. You can look at a 2-year rate and look at the 2-year Canadian bond yield. The path of the bond yield is essentially the market's prediction of future Bank of Canada overnight rate changes and future economic activity. As expectations change, and they change daily, so does the bond yield. An accompanying change to the 5-year fixed mortgage rates may lag, but generally follow the same pattern as shown in the next chart. Bond yields start to move in anticipation of future changes by the Bank of Canada, as well as economic shifts. In the 5-year bond yield chart above, you can see yields started to increase rapidly in September of 2021 in anticipation of significant Bank of Canada rate hikes that started in March of 2022. Now with talk that we're likely at the top or close to the top of the interest rate cycle, we're actually seeing bond yields down from their all-time highs, not all-time highs, but their highs in 2022, with the expectation that we're likely going to see rate cuts versus any more rate hikes as the next move the Bank of Canada does. 5-year fixed rates tend to move in lockstep with 5-year bond yields, as illustrated in the chart. Bond yields can be a very good leading indicator for potential fixed rate increases or decreases. It gives you a pretty good idea of how lockstep they actually do move together. So how does the economy impact mortgage rates? There's 3 economic indicators to watch. Inflation, measured using CPI, Consumer Price Index. Target annual inflation range is 1 to 3%. If inflation runs higher than expected, it can put upward pressure on interest rates. The reverse is also true. GDP measures total goods and services produced. The performance of the economy, measured quarterly, higher than anticipated growth could signal inflationary pressures and upward pressure on interest rates. Again, the reverse is also true. Lastly, job numbers. The number of full-time or part-time jobs, average earnings, unemployment rate, which is published the first Friday of every month, come out, and strong job growth is potential for more spending, which means potential inflationary pressures and upward pressure on interest rates. Again, the reverse is also true. The employment has been pretty sticky, and that's the one consideration why no one's really talking about any rate cuts anytime soon. Inflation has started to ease a little bit. It's still not at the level they want, partially running still high based on the strength of employment numbers. So this is a calendar. If anyone wants this, we can send this over. This is just key announcements every month that you should watch for that will impact interest rates. So the Bank of Canada rate announcements, the US, will not directly related, the Bank of Canada and the US Federal Reserve do follow, we follow the US closely, I should say. The US doesn't follow us closely. Looking at Canadian US monthly inflation reports and job reports as well. So the other consideration that has an impact on real estate and could have a larger impact is government intervention and policy tightening and how that may impact the market. OSFI, which is the Office of the Superintendent of Financial Institutions, is basically the government regulator for all federally regulated institutions, so banks and mortgage companies. Credit unions fall outside of this, but for the most part, a large percentage of mortgage lenders in Canada follow under OSFI guidelines. So there has been talk, and this has been tabled and actually is closing for public consultation this week. So they were asking, industry stakeholders their opinion, talking with the banks, but there is talk that potentially some of these specialty programs or exceptions that we've been able to see could be potentially limited now. Banks would have to keep a certain amount of only a maximum amount of loans on their books that can have a loan to income over 4.5 times someone's earnings. This could have an impact. We have a lot of self-employed programs that are stated income programs. So these are the type of programs that could be impacted. So it'll be important to watch this. The big consideration that could have an impact, which will have a direct impact on how much people qualify for across the board, would be more restrictive GDS and TDS mortgage calculations for uninsured mortgages. So your GDS and your TDS are the 2 main debt servicing ratios that the banks use to qualify you. as it stands right now, the math says that no more than 39% of what someone's gross monthly income, so their income before tax, should go towards mortgage payment, property taxes, $100 for heat, and condo fees. And no more than, so that's someone's GDS. The TDS calculation takes, it says that no more than 44% of someone's monthly income can go towards mortgage payment, property taxes, $100 for heat, condo fees, and then any debt payments. So that would be someone had a car loan or a student loan or a line of credit or a credit card they didn't clear off monthly. So 39 and 44 of those rules, there's been talk that we could potentially see some tightening on that. One of the other big impacts could be for how banks qualify people that have multiple rental properties. So typically, it's a function of your income to debt. And if you have a mortgage payment on a place and say it's $2,000 a month, that's factored into the qualifying of the new place you're trying to buy. Banks want to actually use a stress test, or the OSFI wants to use a stress test on those other mortgages. So not just the mortgage you're trying to buy already having a stress test in the qualifying, but actually taking all of the properties that you own and stress testing those. So using higher payments. So if your payment was $2,000 a month, they may actually be using $3,000 a month as a payment. So this is an action item for someone that's thinking about potentially wanting to refinance and access more funds. They have more than one property. It may be a good time to do it now. If this comes into effect, it will definitely have an impact on qualifying. Sorry. There's another consideration about potentially strengthening the stress test and making it harder for borrowers to qualify. This is a far cry from where we were, in November of last year. There was talk that the OSFI was going to loosen the stress test and make it easier for people to qualify because higher interest rates had a large impact on people. Sorry about that. Now there is talk that we could potentially see OSFI tighten the stress test, which again would make it harder for people to qualify for larger mortgages. So all of these changes are going to basically, if any of them come into play, will make this more restrictive for someone to qualify, which if people qualify for less could potentially put some pressure on the market as people won't have the same amount of budget that they were working with currently today, 6 months down the road if these do come into effect. Thank you very much. That is it. If you want to access my contact info, feel free to scan the contact info. If anyone has any questions, please let me know. But I think it's important to know that no one at all can forecast where interest rates are headed. That's simply it. Even the best economists have no idea. They can give their best guess, but no one thought that interest rates were going to be 4.5% above where they are today. For the most part, even the Bank of Canada in 2020 and 2021 talked about, money staying cheap and go out and spend and rates are going to stay low for the long term. And here we are today in a pretty significant, a much different place than we were. I can't stress enough that, it always comes down to affordability. Just because you qualify for a mortgage, you have to make sure that you're comfortable making the payments. And so, well, obviously these, changes in higher interest rates impact the maximum amount that someone qualifies for. I usually suggest that someone doesn't ever go up to the top end of their budget unless there's circumstances outside of what appears on the application. Maybe they have additional income coming in they don't show or something. But I think the best place to always start is to make sure that you have a firm understanding of your budget and, hopefully have a little bit of a better understanding of how interest rates work. We can get way further into the weeds on this if someone wants to follow up and have a conversation. But, I think there's a lot of news out there, and it's important when you hear, trigger rate. I've heard that on the news a ton myself, or talk about interest rates changing, you have an understanding of what that relates to.
That's great, Jason, and thank you for those key things. And it's interesting to me that OSFI's discussing, things that make it more restrictive almost to purchase, when discussions right now are the younger generation being able to purchase a home, and that's not going to help, what that means going forward. But we will see.
Focusing on supply is the bigger concern that we should be addressing. I think that's not been addressed adequately at all and fails to be, and that's the biggest problem. And especially when we look at immigration numbers as well, putting further upward pressure on both rental and purchase prices, right? So something else needs to be addressed versus making it harder. there have been a few initiatives. There's a first-time home buyer savings account that has recently been launched. And that's something that will help, but it gives the ability for first-time home buyers to access up to $40,000, working similar to how the FSA works, not an RSP where you're actually loaning yourself. So yeah, I think there needs to be quite a bit more done to help first-time home buyers. I think that's for sure.
Yeah, I'm just going to run through a couple up-to-date monthly stats, and then we will sign off this call, just to share that so people understand where we stand at this time. So just very quickly, I wanted to talk about the average sales price, and thank you again to Outline Financial for putting this into a nice chart that we can all see visually. And it's important to note here, what I want to talk about is the difference between the different types of housing. So of course we get this generic average sales price of $1.1 million, around that, yet there's different products perform differently. We can see here with the detached home, during March of 2022, people didn't care where that detached home was, they just wanted to buy one. And that really shot up those prices. And if you compare that to, let's just say, the condo market, which has been this almost steady eddy, which has increased over the years, didn't go up as much in March of 2022. And that was probably due to the effects of maybe COVID, where people wanted that backyard and outdoor space. Didn't decline as much, yet it's leveling off. We haven't seen it increase kind of in condo average sales prices like we are starting to see at the start of this year from January to March when it comes to detached homes. They're still coveted as our semi-detached homes and townhomes. Next, months of inventory. The typical rule of thumb I've heard a number of times is between 4 to 6 months of inventory means it's a balanced market. How months of inventory is calculated if you took all the active listings in a month. So let's just say all the active listings in the month of March divided by the number of sales. And that would tell you, if you didn't put a new listing on the market, how many months it would take to buy out the existing inventory. So when we're right here in March, detached are 1.5, townhomes are 1.1, and semi-detached are 0.8. All of that is below 2. That's very low months of inventory for these products. And that's what's really propping up, I think, helps currently with the average sales prices of homes. Everyone thought there was going to be this big drop off, but not as many people are willing to put their homes on the market, which is creating a smaller pool for buyers and is pushing up prices. Okay. And then lastly, again, this is just nice to look at when we look at the prime rate, as Jason talked previously, and how it can affect average sales price. And more than talking about the high end, you can see when that prime rate starts to drop, how that puts upward pressure on average sales prices. Okay, and especially during 2021 to 2022. So that sharp increase, of course, was a shock to the system, and that dropped average sales prices. But it's important to note here that if we're waiting, if we're saying, okay, the price is right, yet interest rates are high, if you're waiting for, let's say, 2024, when those interest rates come down, typically that will put upward pressure on pricing again. So it's hard to have it all, right? It's hard to get, low interest rates and low sales prices, except, as you noted, Jason, when we go into like recessionary kind of activity.
I think just to interject here, looking at a shorter term fixed rate maybe allows you to buy at a somewhat more depressed market, but then not lock yourself in for 5 years. So when rates do come down, hopefully you're able to maybe catch rates on the way down for a longer term fixed or a variable rate at that time. Yeah.
And I think that's important to note, that this could, everyone's looking for this big dip in the market, but we saw a bit of that in the fourth quarter of last year, and there's still some opportunity now. So the last thing I want to wrap up of what this means for you. So when we're talking about average sales prices this year, if we start from January to December, there was a lot of headlines previously where we're going to continue to see this big drop off in average sales price. And they're talking about year over year, but I'm talking about month over month. I'm sure there'll be some dips this year, yet I think it's going to continue to steadily increase, not massively, but increase month over month. I don't see a big drop off in average sales price. Also this year, from what I'm seeing now, I think inventory is going to remain low. So if you're a buyer looking for properties, you're really going to want someone working on your behalf or trying to find off market or coming soon type properties, because there's not going to be as much inventory as there has been in years past. Why is that? There's many reasons. Again, if someone has that lower interest rate and they're not so inclined to sell, if they can't port that mortgage, it might keep them in their house. A couple other examples are, we have a number of clients who are, let's say, in their 60s or 70s, where before COVID, the natural move was to right size, as they call it, move into a condo. We see less of those people willing to do that right now, enjoying their backyards and saying, I'm just going to stay here and maybe make some, do some renovations so I can stay put, which is not freeing up that inventory. So those are a couple of things we're seeing on the ground. We're seeing more offer dates right now. About 75% of the properties, I would say, are having offer dates. So that's what we're seeing on the ground right now. If you have any other questions, I'm not too sure if anyone does, but I think we can wrap it up there. Thank you, Jason, for providing us with stats and figures so we can understand where we are and where we're going. And of course, as always, everyone's situation is unique, so please feel free to reach out to Jason or myself so we can discuss what makes sense for you.
Thanks so much for having me.
That's it, Jason. Thank you so much. Have a great day.
Have a great weekend. Bye.
Bye now.